The reason your winners aren't bigger isn't entry timing. It's exit psychology. Every trader knows the experience. You take a good entry, the trade moves in your favor, you take profit at the first comfortable level, and then watch the chart run another 20 or 30% without you. That's not bad luck. That's a structural problem with how you're setting targets. Today, why psychology pushes you to exit too early, the measured move math that gives you an actual target, and the structure-based profit-taking system the pros use to let winners actually run. Here's the psychology. Loss aversion is a mathematical fact about human decision-making. Losses feel about 2.5 times more painful than equivalent gains feel good. Translated to trading, that means watching a paper gain shrink hurts more than the gain itself was satisfying. So we exit early to lock in what we have, regardless of what the chart says is possible. Field-based targets are loss aversion in disguise, and they systematically cut winners short while leaving losers running the full distance to the stop. Watch this on a synthetic chart. You enter long at 100, the trade runs to 110 in a week, and you take profit. Comfortable, defensible. 10% in a week is a good trade. Then over the next 4 weeks, the chart runs to 132. You captured a third of the move. That's the cost of field-based targets. They exit at the first comfortable level, and most real continuation moves don't reach their structural target until well past that comfort point. Here's the fix. Replace field-based targets with measured move math. For every setup, there's a structural target you can calculate before the trade triggers. For a breakout, take the height of the pattern that broke and project that distance from the breakout point. For a pullback, project the prior swing range. For a triple bottom, project the height from support to neckline above the neckline break. Math gives you a target that's defined before emotions can hijack the decision. Now with measured moves, the setup formed between 100 and 112, a 12-point pattern height. Project that 12 points from the breakout at 112, and your target is 124. That's the math-based exit, decided before the trade triggered. You don't take profit at the first comfortable level. You take profit when price reaches the projected target. If price stalls before, structure tells you to exit. If price reaches the target, you've captured the full measured move. On a real chart, the practice is straightforward. Identify the pattern, measure the height, project the move, write down the target before you enter. Hold until price reaches the target or structure breaks. Pros often scale out, taking some profit at a halfway point and letting the rest run to the full target. But the discipline is the same. Structure decides exits, not feel. Done consistently, the average winner gets significantly bigger, and the math of your trading transforms. So, field-based targets exit too early because loss aversion is mathematical. Use measured move math to project structural targets before you enter, and hold until price reaches them or structure breaks. Optionally scale out at the halfway point to capture some certainty. That single change in exit methodology often doubles average winner size without changing entries at all. Subscribe for the full method and trade your own plan. Education, not financial advice.